Hello everyone. Today we are going to define some important macroeconomic measures. Measurement is a fundamental issue because we need measures to build a bridge between the macroeconomic theory and macroeconomic reality. In the previous lecture, we established the big picture. The question determines the method, and the method determines the technique. However, if you want to check if your method answers the question, you need to make the theory comparable with the reality. We can translate our economic theory into quantitative models and summarize reality by data. The model and the data need to be built by the same ingredients, namely economic variables. These variables are measures of economic activities. Therefore, the variables in models and data must be measurable and commensurable. Otherwise, you cannot compare the two. Specifically, for macroeconomics, we developed some key measures of aggregate economic performance. We will follow the economic logic to classify these measures. First, for the output market, we use GDP to measure the quantity of output, and various price indices like RPI, CPI, PPI, deflator, inflation, etc. to measure the price of output. For the input market of labor, we use unemployment rate and working hours to measure the quantity of labor input, and wage to measure the price of labor input. These variables will be modeled in topic 1. For the input market of capital, we use savings and investment to measure the quantity of capital input, and interest rate to measure the price of capital input. These variables will be modeled in topic 2. And for the international market, we use trade balance to measure the quantity of trade, and exchange rate to measure the price of trade. In summary, for any market, you can always distinguish quantity measures and price measures. The learning objectives today are the following. First, we have already discussed why we need good measures, because we need to bridge the theory in our mind with the data in the reality. Second, we will define some important measures of quantities and prices in different markets. This will help you understand the language of economists. They are like vocabularies of a new language. In particular, we will spend most of our time in defining GDP, which is the central concept of macroeconomics. All macroeconomic models have GDP, because both economic growth and business cycles are defined by changes of GDP. We will evaluate what GDP measures and what it does not measure. Then, we will go for some technical details of calculating GDP. This piece of knowledge is useful for those who want to work for the ONS, the Office of National Statistics, in your future. And finally, we will also discuss the differences of various measures of prices as well as measures in other markets. Now let's start with the central measure of macroeconomics, GDP. The definition of gross domestic product, or GDP, is the monetary value of final output produced during a given period of time within a country. This statement has some important details to be emphasized. First, it measures output, not input. As a metaphor, you can regard GDP as your exam marks, not the studying time. Some students may spend much time sitting in front of the desk without effective learning, just like countries inputting a lot of resources with a low GDP. After all, it is the outcome that matters, not the input. Second, it is defined in terms of location, not people. For example, a Polish driver who works in the UK contributes to the GDP in the UK, not in Poland. If you want to measure the output in terms of people, then it is the gross national product, or GNP. Third, it focuses on the quantity, not quality, nor distribution of output. A country like the US can have a high GDP, but the distribution of income can be extremely unequal. Fourth, it only contains the market goods and services, not domestic production or underground economy. Therefore, the huge value created by housewives is ignored. So are the transactions of illegal activities by drug dealers and mafia. In some countries like Colombia, it is quite a substantial component of their economies. In addition, GDP does not fully include values created by public goods and services, and costs of environmental damages due to economic activities. Therefore, GDP is not a perfect measure of the output, but it is by far the most popular measure. Almost all economic models are using GDP to measure output quantities. You also need to distinguish between nominal GDP and real GDP. The nominal GDP is measured using current market prices, but it is difficult to know if the growth of GDP is due to the increase of prices or due to the increase of quantity. In contrast, real GDP uses constant market prices, so that the growth is purely contributed by the increase of quantity. In our models, we always use real GDP to measure the quantity of output. Finally, aggregate level of GDP is obviously affected by the population, which varies extensively across countries. To compare like with like, we usually use GDP per capita instead of GDP in aggregate levels in our model. To provide some intuition, let's look at the data of GDP in the US. Over time, the GDP is growing in an exponential way, but the nominal GDP is growing faster than the real GDP because nominal GDP also includes price increases. At a snapshot of this time series in the year 2011, we can see that the GDP can be decomposed into 4 components. Consumption is the largest component, accounting for 71% of the total GDP. The next biggest component is government expenditure, taking up 20%. Investment is about 13%, and net export is negative due to the trade deficit of the US to the rest of the world. This is actually one of the 3 approaches to calculating GDP. The expenditure approach. We will come back to this slide later. Previous slides answer the first learning objective of defining GDP. Now let's introduce how to calculate GDP. There are 3 approaches. The first is the product approach. It is based on the value added in each stage of the supply chain. Given that GDP is essentially a flow of value created by producers, it is straightforward to sum up all the value added of all producers. The second is the expenditure approach, based on the value received by different economic agents in the economy, including consumers, firms, the government, and foreigners. C here stands for the consumption received by consumers. I is the investment received by firms. G is the government expenditure received by the government. And X minus M is export minus import, or net export, received by the rest of the world. This is the approach we illustrated in the previous slide. The third approach is the income approach, based on the value distributed to different economic agents in the economy. It includes wage for consumers, profit for firms, interest for a special type of firms, banks, and taxes for the government. To illustrate, let's assume there is a fictional island. There are two types of firms in this model island. The first type is a coconut producer, producing coconut by employing labor and capital. The second type is a restaurant, which produces processed coconut using raw coconuts produced by the coconut producer and labor as input. The two firms form a simple supply chain of the economy. The coconut producer is at the upstream and the restaurant is at the downstream. Consumers can either consume raw coconuts from the coconut producer or processed coconuts from the restaurant. Finally, the government imposes tax to pay for national defense to protect the island, for example, from the pirates and wild animals. We can use this flowchart to summarize the structure of the economy. Despite simplified and idealized, this model actually well describes how a real-life economy works. The consumers provide labor and capital to firms in the input market, while firms supply output to consumers in the output market, which is the coconut market. Investment is financed by bank credit, just like in reality. And as the public sector, the government also needs to employ labor from the input market and provides public goods and services in the output market. In our case, it's the national defense. Let's now look at the cash flows of each agent. That is to say, we will calculate the revenue, costs, and profit for each agent. For the coconut producer, assume it produces 10 million coconuts sold at £2 each. So the revenue is equal to £20 million. The total costs include a wage bill of £5 million paid to consumers in the labor market, interest payment of £0.5 million paid to consumers via banks in the credit market, and taxes of £1.5 million paid to the government. The profit is the gap between revenue and costs of £13 million. Note that this profit is owned by the shareholders of the firm. In reality, not everyone is a shareholder. Only those rich people or capitalists own the share. However, our question at hand is to calculate the quantity, not to discuss the distribution. So, it does not matter who owns the profit. On average, everyone owns it. For the restaurant, we can do the same accounting practice. Assume the processed coconuts are more delicious and sold at a higher price of £5 each. The total revenue of the restaurant is therefore equal to £30 million for an output of 6 million processed coconuts. The costs of the restaurant include the cost of buying intermediate goods, the raw coconuts, from the coconut producer at the price of £2, equal to £12 million in total. For each coconut processed, the value added is £5 minus £2, which is equal to £3. The total value added is therefore equal to £18 million. This figure will be useful for the product approach later. And of course, the restaurant needs to pay for the labor costs and taxes. The profit is equal to the gap between the revenue and costs, which is £11 million. And again, this profit is owned and distributed to shareholders. Now let's look at the consumer. Not all consumers work for both firms and government. But we are talking about the average or per capita quantity, so we can treat consumers as one person. Note that if the question is to discuss the distribution of output, then you should not treat consumers as one because they have different wages and different jobs. but now we treat them as a whole unit. The income of this per capita sense consumer includes labor income from the two firms and the government, the interest income from the coconut producer via banks, and the profit income from the two firms in the form of dividends. These figures are consistent to previous slides, so please check. The expenditure includes the demand for raw coconuts from the coconut producer, the demand for processed coconuts from the restaurant, and an income tax paid to the government. If there is no mistake, the total income should be equal to the total expenditure, or break even in the accounting jargon. Finally, let's look at the government. Treat the government as a special type of firm which receives revenue by imposing taxes and produces public goods and services. The income includes the corporate taxes received from the two types of firms and the income tax from the consumer. The expenditure is the costs paid to a special type of labor, army services, to provide national defense. It is effectively the same as the wages in other firms. This figure is also consistent with the consumer income statement in the previous slide. The public sector also needs to break even, just like the consumers. As you can check, the income must equal to the expenditure. Now we are ready to practice the three approaches of calculating GDP. In the product approach, we need to sum up all the value added in each stage of the supply chain. There are three types of products, so three components of value added. The first component is the value created by the coconut producer, which is 20 million pounds. The second is the value added by the restaurant. We already calculated that in one of the slides. It's 18 million pounds. The third is the value created by the government in providing public services, which is equal to 5.5 million pounds. The total GDP is therefore the sum of the three, equal to 43.5 million pounds. The second approach, the expenditure approach, sum up the four expenditures: C, consumption; I, investment; G, government expenditure; and net export. In this simple model, we don't have any investment or export, so we simply sum up the private consumption C and public consumption G, which arrives at the same figure of 43.5 million pounds of GDP. To recap, we go back to the GDP of the US in real life, where investment and net exports are included as well. But the relevant importance of C and G in the data is well matched by our simple model. The third approach, the income approach, aggregates all types of income of all agents. The wage income belongs to consumers. The profit income belongs to shareholders, but ultimately to some consumers. The interest income belongs to banks, but again, ultimately to some consumers. Taxes are income belonging to the government. So the sum of all above is again equal to the same figure as the previous two approaches. In fact, the three approaches are three equivalent ways of looking at the same thing, the total value created. Any value must be produced by someone. That is the principle of the product approach. Any value must be consumed by someone. That is the principle of expenditure approach. And any value must be owned by someone. That is the principle of the income approach. I suggest you to practice these three approaches to familiarize yourself with what to include and what to omit in calculation. There are loads of exercises available in the self-test questions on the module website. It is basically an accounting job. That is why calculating GDP is also termed as national account. We have now finished the most challenging job today, how to measure the quantity of output. Now let's move on to the measure of price level of output. Different from microeconomics, where prices are clearly defined for specific products, the price level in macroeconomics is defined for all products in the entire economy. There are two measures to measure general price levels. The first are price indices, which are basically weighted average of individual prices of various goods. They usually cover different types of products. In the UK, RPI was used as the monetary policy index before switching to CPI. RPI covers prices in retailers such as Tesco and Marks & Spencer. CPI, on the other hand, covers a wider range because some consumer goods are not sold by retailers. PPI measures the general price level of products at the factory gate at the upstream of the supply chain, so generally lower than CPI and RPI. These price indices are connected, but not necessarily converge due to their different coverages. The second type of measure of price level is GDP deflator, which is derived by comparing the nominal and real GDP figures. Since it is based on the entire GDP, it usually covers a broader range of products than price indices. The definition of GDP deflator is equal to 100 multiplied by nominal GDP divided by real GDP. And as mentioned earlier, the two measures of GDP are calculated at different prices. In macroeconomic modeling, we usually use deflator to measure the general price level and calculate inflation, not the RPI or CPI indices. As shown in the graphs, GDP deflator tracks CPI in percentage changes quite well, but the levels of the two diverge substantially. The reason for CPI to grow faster than the deflator is because consumption only accounts for about 71% in GDP, as shown earlier in the GDP composition in the data. Finally, let's briefly go through measures of quantities and prices of other markets. In the capital market, which is one of the two input markets, the quantity of capital can be measured in flows or stocks. Savings and credits are flow measures, and you can distinguish them between private sector and public sector. They are both supply side of the capital market. Investment is also a flow measure, which is the demand side of the capital market. It includes both firms' investment on machinery and equipment, as well as households' investment on houses. It is also known as fixed formation of capital stock in national accounts. Depreciation is the negative flow of investment because capital has a limited service life. Capital stock is a stock measure calculated at a particular point in time. You can distinguish between physical capital and financial capital. The prices of capital can be measured by various interest rates for financial capital and by rental rates for physical capital. In the labor market, which is the other one of the two input markets, the quantity of labor can be measured in terms of extensive margin and intensive margin. Unemployment rate measures how extensively people work or not work. Participation rate measures how extensively people are active or inactive. Working hours measure how intensively people work if they do work. Prices in the labor market are measured in nominal or real terms, just like GDP. In economic models, we usually use real wages, which are denominated by output rather than by money. After all, it is the purchasing power of your income that matters, not the number. For international markets, quantities are measured by foreign trade and assets. The balance of payment is equal to current account plus capital account. Current account is basically the trade balance. Capital account includes foreign direct investment or FDI and portfolio investment. Prices of trade are measured by exchange rates, both in nominal and real terms. Terms of trade is the ratio between export and import prices. A higher terms of trade implies a better deal for the home country, but a worse competitiveness against foreign goods. We will reintroduce these measures in corresponding parts of the module in the future, so don't worry if you cannot memorize all these definitions. What you need to take away after this lecture is that you can always categorize economic variables into quantities and prices. Please read the corresponding chapter in the textbook and try to do the self-test questions available on the module webpage. For those interested in the differences among measures, please click these links for further reading. Have fun!